Good day, friends. In the subject of personal financial planning, insurance planning is very important. In my previous lecture on insurance planning, I talked about what we mean by insurance, why insurance is required, that is, the life is full of uncertainties and risk. So in order to mitigate our risk, basically it's a risk management system, and you can manage your risk, you can transfer your risk and the uncertainty, at least the financial part of it, to some other company, that is some other person. And what are the different types of risk? I just referred in my previous lecture. Basically, I talked about life insurance and the general insurance. In this lecture, to start with, I'll be talking about principles of insurance. That what are the basic principles on which the insurance policy or the insurance depends. So when a company insures an individual entity, these are the following principles of insurance. As I said in my previous lecture, there are two parties. It is an agreement between the two parties. One is called the insured, who is getting the insurance, and the other is called insurer, one is called the insurer, who is getting the insurer, and one is insured and the other is insurer. Insured is the person or the company which is getting the insurance, and insurer is the company which is giving the insurance, right? So there is in form of company, the company gives the insurance, a policy holders who is called insured takes a policy, and the insurer, which is a company which is called insurance company, gives the policy to the person or the company or the entity. So there are certain basic principles, premises which must be followed in the insurance. First thing is, we must understand that insurance is not for profit. It is for indemnity. Indemnity means to fulfill the loss to the extent of the insurance policy. We call it indemnity. The insurance company shall indemnify or compensate the insured for certain losses only up to the insured interests. What it means is that it's a policy, it's an agreement of fulfilling the loss to mitigate the loss to the extent of the insurance policy. What it means is, I cannot make profit out of it. If I have taken a policy, suppose I have taken a car insurance, which covers if anything happens to if there is any accident takes place and any damage takes place to the car, the insurance company will get the car repaired and will pay the expenses involved in the repair. So I have taken an insurance of to the extent of 3 lakh rupees, right? So what it means is that I cannot claim 5 lakh rupees from the insurance company, or supposing, let me put it this way, that an accident takes place and a minor damage to the car takes place. For repairing the damage to the car, 50,000 rupees has been spent. So I cannot claim from the insurance companies that since my insurance is of 3 lakh rupees, you must give me 3 lakh rupees. Because it is an agreement to indemnify. If my loss is to the extent of 50,000 rupees, to keep the car in the previous condition before the accident, right? So whatever the condition of the car was before the accident, and after the accident, 50,000 rupees was being spent to get the car in the same shape, right? In the same condition, I'd spent 50,000 rupees. So at the most I can claim, at the most means I can claim 50,000 rupees from the insurance company. I cannot claim more than 50,000 rupees, because it's not an agreement of making profit, even if my insurance is of 3 lakh rupees, right? In case the loss is much higher, means if it is, say, for example, 2.5 or up to the 3 lakh rupees, then the company will pay me 3 lakh rupees, but not if the amount spent by me on the repair of the car is less than 3 lakh rupees, company will pay me only 3 lakh rupees. What it means is, it's not a profitable thing. It's not policyholder should not take the policy for making profit out of it, right? So it is only indemnity. Indemnity means it's a fulfillment of the loss to the extent of the policy. When I am saying to the extent of policy, suppose a fire insurance has been taken and I have taken a fire insurance of 5 lakh rupees, and if a loss has taken place due to the fire of my property to the extent of 30 lakh rupees or 35 lakh rupees, so the insurance company will pay me maximally 5 lakh rupees, right? So it's a agreement. The basic principle is to indemnity, means it is basically to indemnify or compensate the insured for certain losses only to the insured interest. The other thing which is important, which is one of the principle of the insurance, is insurable interest. The policy which I am taking as a policy holder, right, as a insured, I must have insurable interest in the person, in the property, in the asset for which I am taking the insurance. This means that the loss must be directly suffered by the insured. Insurable interest must be present whether property insured or insurance on a person is involved. The overall idea is that the insured have a stake in the loss or damage to the property insured, right? It is my business. I am running a shop, I am running a factory, and I am getting my factory insured against, say, again let me take the fire example, fire, right? The creditors who have given me the credit, they may have insurable interest. Suppose a bank has given me a loan worth 25 lakh rupees, 30 lakh rupees, or any sum of money. Then the bank can get my goods insured because bank has an insurable interest that in case if any fire take place in my factory's property, of my goods, right, that is lying there in the stock, and against that stock I have taken the insurance. I have taken the loan from the bank. If any damage takes place to that stock, I'll be finding it very difficult to pay back the money of the bank, that is a loan amount, because if I make a heavy loss in the business because of the damage of that goods, I'll be in a difficult position to pay back the loan of the bank. So bank has an insurable interest in the stock that is there in my factory. Bank is not directly, it is not bank's property, it is not bank's stock, it is my stock, my business stock. But bank has a insurable interest because the bank has given loan to the company, loan to my company, and if any damage takes place of my stock, to my stock, in that case I as an individual find it difficult to pay back the bank's loan, right? So principal amount and the insured amount. So that is a bank has a insurable interest. I cannot get the life insured or health insurance of a person who is passing by of my neighbor. I can get the health insurance or life insurance of my spouse, that is my wife, my children, right? Because I have insurable interest in the life of my children and life of my spouse, right? I have insurable interest. So the party which is taking the insurance policy must have insurable interest in the object for which the person is taking the insurance, right? So without insurable interest, the insurance should not be taken, or insurance is not being taken. So insurable interest is a very, very important aspect or important principle of insurance. That is, the person who is taking the insurance must have a insurable interest in the object of which the insurance is being taken. It may be in case of, as I have given the example, it may be, say, creditors may have an insurable interest in your business because the creditors have given you the money. And if anything happens to your business, if you are not filled, supposing I am buying a car, right? And for that car I have taken the loan from the banks, or I have taken a loan from the company which is selling the car. These days even the company which are selling the car, they make the loan arrangement. So if any accident takes place, if any damage to the car takes place, right, and if tomorrow I said I have no concern with this, in that case how the money will be recovered? So the insurance, the company which is giving me loan against that car has a insurable interest. So insurable interest must be there for getting the insurance. What that stake is will be determined by the kind of insurance involved and the nature of the property ownership or the relationship between the persons. I have already spoken about it. So, the requirement of an insurable interest is distinguishes insurance from gambling, right. So, in the gambling there is no insurable interest, there is no interest involved, but in the insurance there must be a interest involved in the things of the object for which you are taking the insurance. And third is utmost good faith. You must tell all the truth while taking the insurance. Uberima fights. It means the insurer and the insured are bound by a good faith, bond of honesty and fairness. In simple terms, material facts must be disclosed. Sometimes, normally the policy holders always blame the insurance company that many things are being concealed from the policy holders at the time of giving the insurance. This violates the principle of utmost good faith. Similarly, the person who is taking the insurance, that person should also reveal all the facts which he or she knows. Let me again take the example of health insurance. Suppose a person, an individual is taking a health insurance policy up to the extent of rupees, say 20 lakh rupees, that if anything happens, any ailment takes place, right, so on medical expenses to the extent of 20 lakh rupees is being incurred in a year, then the insurance company will take care of these expenses. But when the person was taking the policy, at that time itself, he knew it that he has some kidney problem. There is a chances there is only one kidney is functioning, the other kidney is not functioning, right? And this fact was not being revealed to the insurance company at the time of getting the policy. This means it is the violation of utmost good faith. In that case, the insurance company will have all the right to reject the claim of the person who has taken the policy, because knowingly the individual did not reveal this fact to the insurance company, right, that he is suffering from this ailment. Had he revealed it, probably either the insurance company would have increased the premium amount, or it might not have given the insurance policy. So, the principle of utmost good faith is being violated. Similarly, from the company point of view, let me take this example, that at the time of health insurance, the agent or the person who came on behalf of the insurance company revealed that all ailments will be covered, that you take a health policy and any expenses that will be, he will just give a statement that any expenses, medical expenses take place to the extent of the policy amount, say 20 lakh rupees, all the 20 lakh rupees will be paid by the insurance company in case of the hospitalization. But there are certain ailments which are not being covered in that insurance policy. This fact they have written in their document in a very small words, or this fact was not being revealed to the individual, to the policy holder who is taking the policy at the time of giving the insurance policy. And if it is being proved that the individual was not being revealed, that the following ailments are not being covered at the time of giving policy, said any medical expenses that will take place to the extent of this because of any ailment, the insurance company will pay for it. But since the individual has taken in good faith that any ailment takes place, I will be covered to the extent of 20 lakh rupees, but the many diseases, like say for example cancer, kidney failure or some other serious ailments were not being covered by that policy, right? There are different natures of policy, there are different type of policies. So that policy which the policy holder has taken does not cover these things. So it is a violation of good faith. What it means is that both parties, insurer and the insured, who is getting the insurance, who is insured, and the insurer who is giving the insurance, that is the insurance company, must reveal all facts, so that both the parties can make a wise decision and the right decision. So, principle of utmost good faith, that is the insurer trust insured and insured must trust insurer, and all the material facts. What is material facts? Material facts means the fact which can impact your decision of taking the policy. From the policyholder's point of view, fact which can affect the company, that is the insurer, to make the policy. That is, had the insurer knew the fact, the insurer would not have made the insurance or would not have given the insurance, right? Or had increased the premium of the insurance, right? So it means the utmost good faith must be followed by both the parties. Contribution. See, both make some contribution. Insured will pay a premium to the insurer. See, I as an individual, I am taking a policy. I am also contributing. My contribution is in the form of paying a premium to the insurer, that is the insurance company. What is the contribution of the insurer? Insurer's contribution is, if something happens for which the policy was being taken, then the indemnify the loss to the policyholder is the responsibility of the insurance company, that is the insurer. So insurer with similar obligation to the insured contribute to the compensation or indemnification. What it means is, both parties are making some contribution. The insured, the person who is taking the policy, contributes in the form of paying the premium, right? By paying the premium, the person is making, or the company is making the risk management. Company means the insurance is not being taken by individual. Insurance can be taken by corporates, houses, business houses, and all those things, right? So all those entities. Similarly, the company which is giving the insurance contributes if any loss takes place for which the insurance has been taken. It is the responsibility of the insurance company to compensate, to indemnify that loss. Another important principle of the insurance is subrogation. What does subrogation means? The insurance company acquires legal rights to pursue recoveries on behalf of the policy holders. For example, the insurer may sue those liable for the insured's loss. The insurers can waive their subrogation right by using a special clause. What it means is, suppose, again let me take the example of a fire insurance. I have taken a policy of a fire insurance of my business. I am running a business and there are certain stocks, right? So of that stock, the policy of which against which the fire insurance has been taken, a fire took place and the loss to the extent of 50 lakh rupees take place. I put a claim to the insurance company for compensating of my loss to the extent of 50 lakh rupees, right? But this fire took place because of the negligence of one of the individual who was smoking, and he threw his cigarette in the stock knowingly that this is a very sensitive, fire sensitive stock. So the insurance company, as far as I am concerned, it was not my fault. The insurance company will have to pay me the loss of the property which has taken place. But insurance company has all the right to file a legal case against an individual, that is the person, the negligence, because of the person's negligence that fire has taken place. So against that person, under whose negligence that fire took place, the company has outright to file a suit against him. So means the legal right passes on to the insurance company, right? So supposing again an accident takes place in a car insurance and the car damaged beyond repair, right? So I'll claim to the insurance company for paying the insurance amount. The insurance company pays to me the insurance amount. So whatever the remaining portion of the car is, that car's right belongs to the company, not to me. Insurance company has paid me the 5 lakh rupees. Suppose I have taken an insurance of 5 lakh rupees of the car, and the car is beyond repair, means the condition of the car is that it cannot be repaired. So the insurance company will pay me 5 lakh rupees, and the car's right will be automatically transferred from myself to the insurance company, right? So insurers can waive their subrogation right by using a special clause. it is up to the insurer that if he or she, if the company so wants, it can subrogate rights by using special clause. Causa proxima or proximate cause. What is the cause of the damage? What is the reason of the damage? You have to see, and whether that reason has been insured or not. This is also important. The reason behind the loss must be covered under the policy's insurance agreement, and the dominant cause must not be excluded. See, I am running a car. Suppose an individual, Mr. X, is running a car, and the car is insured against accident, against all losses, but it is being proved that the person, Mr. X, was drunk at the time of the driving. At the time of accident, Mr. X was drunk and he was driving the car. So, the causa proxima of the accident was that the person was drunk, and because of his condition, an accident takes place, because he was not in his full sense, and because of that, the accident takes place. But under this car insurance document, car policy documents, when the insurance took place, there is nothing like that if the person is not in the full sense and the person is driving the car, and if an accident takes place, right, even in that case, the insurance company will cover the amount. So, the causa proxima of the accident was that the person was not in full sense, and because the person was not in full sense, or a person, supposing he is driving in a night time, and in that night, because of his drunk position, suppose he felt sleepy, and because of that sleepiness, the accident takes place. So, in that case, the insurance company is not liable to pay the damage, right? Because the causa proxima, the main reason of the accident was that the driver of the car, the person, was not in full sense and he was drunk. Because of that, because of individual's negligence, intentional negligence, I would say, the accident takes place. So, if the accident takes place because of your negligence, right, then the insurance company is not liable to pay that loss. So, we will have to see that which is the reason, what is the main reason of that loss, and whether that main reason is being covered by the insurance policy or not, insurance terms and conditions or not. So, this is important, that we must see what is the main reason of the loss. Now, next is mitigation. In case of any loss or casualty, the asset owner must try to keep loss to a minimum, as if the asset was not insured. It is the responsibility of the individual who is taking the policy, because, as I said in the beginning also, the agreement between the insurer and the insured is an agreement of trust, that both parties trust each other. So, as a policy holder, if I am taking a policy of any property, anything, right, as I must try to minimize the loss. Suppose I have taken a house insurance, right, and when I have taken a house insurance, suppose a natural calamity, some flood took place, right, minor flood took place. In the minor flood, the water entered into the house. What I should try? I should try that all the furniture, all the belongings that are there on the ground floor, I should take it up, or I should keep it at a place, providedly the time permits, providedly other things are there, so that the loss is being minimized. I didn't try that. I said, okay, the goods are insured. Why should I take care? Let it be loss be, right? And I didn't try anything to minimize the loss or minimize the loss of my property. This is against the principle of insurance, right? So, insurance principle says that whenever there is a loss or taking place, the policyholder should try to minimize that loss. That is, it should try as if the asset is not being insured, as if I'm not going to get any compensation of the loss that will take place from anybody. So, I must try to mitigate the loss. So, that is the principle of mitigation. because this insurance is a agreement of trust. Now, after talking of the principles of the insurance, let me talk very briefly about the meaning of the risk. Although I started with the risk itself, uncertainty itself, in my first lecture also when I start talking about the insurance, but let me define what risk is here. Risk is an essential concept in any discussion of insurance. In insurance, risk is defined as uncertainty concerning economic loss, right? So basically, risk is the uncertainty, what is going to happen tomorrow. Nobody's known. Life is full of uncertainties. So this uncertainty is basically the uncertainty of the economic loss. You may argue that life cannot be measured in money terms, so there is no economic loss. But in case of life insurance, we treated that if anything, it works in two ways. One, it works as a saving, that up to a particular period of time, you keep on paying the premium, and after that period of time, the person remains alive, then a lump sum money is being given back to the person, right? That is the policy holder. So it acts like a saving also, it acts like a investment also, and at the time, at a particular age, you get a lump sum money, which is a reasonable sum of money, because over a period of time, the insurance company also makes some profit, and the part of the profit which we know as bonus is being transferred to the policy holder. The part of the profit is being transferred to depending on the terms and conditions of the policy. There are different type of policy, right? So in that case, there is no exact economic loss. But supposing something happens to the individual before the expiry of the policy, that in that case, the person's dependent or person's nominees will get the money, and with this money, they can have their at least financial liability, financial freedom, I would say, right, to some extent. So, for example, will you continue to be employed? What happens if your spouse dies prematurely? What if your home is destroyed by a flood? What will happen to your old age when you have not saved enough to retire? These are all types of uncertainties which we, from insurance point of view, which we are calling it risk. See, as far as the finance textbooks are concerned, financial textbooks or as per the financial terminology, I would use the word, they talk of two types of risk: systematic risk or unsystematic risk. Systematic risk is alike for everybody. So systematic risk is that type of risk which is impossible to avoid completely, which is similar to all, right? Which is impossible to avoid. Examples of systematic risk includes recession, inflation, and war. Right? Any war takes place, so it will impact the whole economy, it will impact the whole business, it will impact all lot of individuals. If the recession takes place in the economy in the world, it will impact all business. The degree of impact may vary from industry to industry, from business to business, from individual to individual. But recession is going to impact everybody. Same is the case for the inflation, right? Different industries are being impacted differently at the time of inflation. So you can do very little to protect yourself from systematic risk, and no amount of profitable diversification can eliminate such risk, right? You cannot fully diversify the systematic risk. As far as the unsystematic risk is concerned, it is that affects an isolated group of companies, industries, countries, right? So if I am talking in financial terms, so diversification substantially decreases or eliminate unsystematic risk. So means what it means is systematic risk is going to impact all. The degree of impact may vary from one individual to another individual, one business to another individual. But as far as the unsystematic risk is concerned, it affects a particular groups of companies, it affects a particular industry, it affects a particular country. Supposing a war takes place, right, between the two countries. A civil war takes place within a country. So from the world point of view, it is an unsystematic risk because it is a country-specific risk. If I'm looking from the world point of view, from world risk point of view, it is an unsystematic risk, right? So diversification will not impact, substantially decreases or eliminate unsystematic risk. Suppose a person has invested company has invested in a particular country, and some war takes place in that country. It may be civil war. So if the company has invested in other companies also, other countries also, so risk will be diversified. What it means is unsystematic risk can be diversified, systematic risk cannot be diversified, right? So with these words, friends, I'm ending here. So I'll be continuing with the insurance planning in my next lecture. In today's lecture, I have talked basically about what risk is, what is systematic risk, what is unsystematic risk, and we talked in the beginning of the lecture about the principles of insurance. Thank you.